This is the chart bulls want to see every morning, and this is the price of gold. The price of gold has increased over 17% since the beginning of 2024, from just over $2,000 to just under $2,500 an ounce. And this trajectory shows that the show is still on. The sustainable price gain and the trust we have in the asset are the reasons why most investors make gold a part of their portfolio. If you're interested in expanding your portfolio and making gold a part of it, this video is for you. In this video, I'll be discussing the different ways that you can trade gold. Success in trading is largely determined by your entry and exit points. So I'll be sharing my personal strategies for conducting a preliminary research to help you maximize your profits. So strap in, and if you haven't done so already, make sure to subscribe to the channel and hit the bell icon for updates. This way, you'll receive notifications every time I post a valuable trading video content. So let's get started. Gold can be traded in a variety of different ways. One of the most popular ways to trade gold is through contracts for differences, also known as CFDs. CFDs are only available to non-US traders, and they're a type of derivative trading that allows you to speculate on the rising and falling of prices in fast-moving market environments, such as gold, without actually owning the physical asset. When you trade gold CFDs, you're essentially betting on whether the price of gold will rise or fall. If you believe the price of gold will rise, you go long the CFD. If you think the price will fall, you go short CFD or you sell it. Your profit or loss is determined by the difference between the price when you enter the trade and the price when you exit. What makes CFDs particularly attractive for traders is the use of leverage. What leverage does is that it allows you to open a position on margin. In other words, you're only required to deposit a small percentage of the full value of your overall position, just like futures, which I'll talk about next. This means that the potential profits, as well as losses, which is a very important component of it, are magnified. So your profits are magnified, your losses can be magnified. However, doing this exposes you to additional risk, and a small move against your position in slightly volatile markets could crush your portfolio. So make sure you're aware of that. Leverage comes with risk. It's crucial to understand these risks and to have the strategies in place to manage them, which is why it's absolutely important to use stop loss orders, which can limit your potential losses. A stop loss order automatically closes out a trade at a predetermined level to limit your losses if the market moves against you. Now, if you're not American, our broker partner ACAP is our preferred broker for trading gold CFDs. If you're American, consider Apex Trader Funding, which allows you to trade gold futures. Yes, another popular way of trading gold is through futures. When you trade gold futures, you're entering an agreement to buy or sell a specific amount of gold at a future date. Futures contracts are probably the most popular way to trade gold for Americans. The price is set at the time of the contract, and it doesn't change regardless of the fluctuations in the gold market. The standard futures accounts are a very popular way for Americans and non-Americans to trade gold. Just like CFDs, futures trading allows the use of leverage, meaning you can control a larger amount of gold with a relatively small amount of capital. Of course, the leverage in futures is much smaller than the leverage in CFDs. For example, with just $100, you can use a leverage of 10 times, for example, and you can purchase gold worth $1,000. However, trading futures with high leverage also means higher risk. It's very important to know that futures contracts come with their own set of risks and complexities. For example, they require a certain level of margin and have specific contract expiration dates. Therefore, it's essential to understand these aspects before diving into gold futures trading. A standard gold futures contract allows you to buy or sell 100 ounces of gold, with each point being worth $100. Now, there are E-mini gold contracts that are smaller size. So you can trade what they call the micro gold contracts, which allows you to buy 10 ounces of gold. At each point move is then worth $10 instead of $100. There are several platforms where you can trade gold futures, and Apex Trader Funding allows you to access that utilizing their capital, and you can pass the prop trading challenge and get funded to trade gold. And we at BK trade gold every single day. Now, Bitcoin ETF, does that ring a bell? You might have heard this term on the, all over the internet if you have any exposure to trading, which, is ETFs. ETFs are basically exchange traded funds, and it's another way to trade gold. Gold ETFs are investment funds that basically track the price of gold. So let's make it simple. When you invest in a gold ETF, you're basically buying shares in a fund that holds physical gold, or it invests in gold futures. This allows you to gain exposure to the price of gold without actually having to store physical gold. Like CFDs and futures, trading gold ETFs also involves risk. But usually with gold ETFs, you don't have the same type of leverage that you do in CFDs or futures. The price of gold, though, can fluctuate, and that will affect the value of your investment, and it will move along with it. The gold ETFs provide a simpler way to invest in gold, but they do come with fees, and these fees can eat into your returns. So it's absolutely important to understand them before you start investing or trading these gold ETFs. There are several popular gold ETFs that you might consider looking at, like iShares Gold Trust Micro ETF, IAUM, which is known for having the lowest expense ratio, Invesco's DB Precious Metals Fund, recognized for its performance, and SP Spider Gold Trust, which offers traders the best liquidity. Now that you know the different ways to trade gold, it's important to understand the key points of how to trade it. One of the key aspects is understanding the contract size and the value of a point. And we touched on this briefly with futures. In gold trading, the contract size refers to the amount of gold in ounces. A one standard lot in gold is equal to 100 ounces. Each platform and each method that you trade has different lot sizes to trade. On MT4, MT5, for example, the standard lot is 100 ounces with a minimum trade amount of 0.01 lot or 1 ounce, and a maximum exposure of 10 lots or 1,000 ounces for certain brokers. Another term that you may hear a lot is the value of what a point is. The value of a point basically refers to the monetary value of each minimum move in the price of gold. This value is different depending on, what you're trading and the specific contract and the platform that you're using for trading. For example, if you're trading gold futures contract with a contract size of 100 ounces and the price of gold moves by $1, you would make a profit of $100, which is basically 100 ounces times $1. Conversely, if the price of gold drops by $1, you could lose $100. If you prefer to trade a micro size, a smaller size, then you can go to the micro gold contract, which allows you to buy 10 ounces of gold, and a 1 point move is worth $10. Now, when it comes to choosing the way you want to trade gold, you need to consider the fees, the lot sizes, what country you're in, the spread, the access to the market. The spread in gold trading is different based upon, how you're trading, either through the futures market or through CFDs. And CFDs are usually the prices provided by the brokers themselves. And just like in all other markets, you'll find bid prices for gold are always, similar, but, there could be a little bit of differences. That's where the spread is, and the spread can impact your profitability in gold trading. So as a trader, you would prefer a broker that offers tight spreads, like ACAP, for example. And if you're interested in trading gold with us, there's special links below with, offers with ACAP. Gold is thankfully a market with very, very high liquidity. It's an asset that's traded around the clock and across the globe, which means that there are always going to be good prices in the active market. And this gives gold more volatility, opportunity, and tighter spreads. The price of gold is affected by a whole bunch of different things, including supply and demand, how the US dollar is moving, how US data is moving, because gold is priced in dollars. And when the dollar is very strong, that tends to prevent gold from rallying and actually pushes it lower. When the dollar is weak, the US dollar, it tends to support the rally in gold. And of course, market sentiment. If there are, markets are nervous, it tends to be good for gold. If markets or investors are optimistic, that tends to be bearish for gold. Keep in mind, it's important to keep in mind these factors and how they impact the gold prices, because they can give you an edge in your trading. And especially when there's geopolitical risks like wars, epidemics, and other global situations that can affect supply and demand. There's been a lot of Chinese buying for diversification purposes, and that also affects things. And so those are some of the fundamental factors that can affect gold. So when you're trading gold, it's important to stay on top of the fundamental factors, the technical factors, and news to select the best trades. We at BK trade gold every day, and we helped many traders pass their prop trading challenges trading gold. If you're interested, check out the links below for a huge discount with Apex Trader funding. So that's it for this video. If you found this video helpful, please give it a thumbs up and share it with your fellow traders. And don't forget to subscribe to the channel and hit the bell icon to get notified about our future videos. Happy trading.